Friends, today I'm going to talk on one of the sequel which I have done it. Last time I've spoken on the subject of issue of taxation of shares and derivatives in income tax. Now today I'm covering case studies on that. Case study would take you to a different understanding on certain parameters. First thing, I will take it into a classification of shares or security as stock in trade or capital asset. So now how it will impact. There were many litigations going on in the court, in the CAT tribunal court and all these things. So government is to reduce the litigation as they should certain notification and clarification what is shares and what is stock in trade. So it make it clear. Now I have taken into consider case study to transfer of unquoted share and its impact. Case study number 3, impact of section 56 to 10 on fresh issue of capital. Case study number 4, transfer of shares under pre-arranged agreement. The case study fifth one is transfer of shares of listed company and its impact under cost substitution under section 55 to small IC under income tax act. Buyback of shares of listed company. So I'm taking case study number 1, classification of shares as stock in trade or capital asset. Capital asset is defined in section 214 of the Income Tax Act. Government has specifically excluded stock in trade qua capital asset. All the security held by FII will be always deemed to be a capital asset. First, there was a issue going on when FII invests shares in investment. Would they consider it as a capital asset or stock in trade? If FII invest in India and their purpose is to earn money and go abroad, so that will always considered as stock in trade. But now government had made the settled law. They have inserted in the law only. Any security investment made by FII, it would be considered as stock, as capital asset. As it is capital asset, it would be liable for short-term gain or long-term gain. Short-term gain would be discounted rate 15%, long-term gain 10%. Different taxation I've already covered. Plethora of judicial precedent and CBDT guidelines available on taxability arising on transfer of security. Illustrative factor for judicial precedent determining what is capitalized and stock in trade. How you treat in your books of account? In my books of account, I can have a two option. I can show it as a stock in trade. Stock in trade would be considered as investment, and investment would be a cost of market price, whichever is less would be shown. And if it is capitalized as an investment, there are basically my it is I would hold it for a very long time. So my the way I deal with the transaction would also show whether it is stock in trade or not. Manner of valuation in my book, quantum and frequency of transaction. Suppose I borrowed the money for the purpose of issue. Suppose I bought a 1 crore Reliance. Out of that, 98 lakh I borrowed from, or I borrowed it from my friend. So it would be always considered as stock in trade because my purpose is to make profit. But if I have my 2 crore rupees and I invest in stock in trade, my purpose is to invest the money of the surplus fund available to me. And how many periods I am, suppose I hold Reliance for say 5 years, 2 years, 3 years, as investment. But my purpose is to sell it. Then it is the period of holding would also be a majority factor for the purpose of considering it. And it is like this: 2 crore Reliance share. 1 crore I consider it as a stock in trade, and 1 crore I can consider as an investment. And it would be, once I would consider it as stock in trade, it would be a stock in trade. Once I would consider a business profit as a capital asset, it would be considered as capital asset. It would also be taken into consideration on the basis of the character of the transaction in the period of which I hold. Once I consider as a capital asset, I cannot treat it as a stock in trade. Once I consider a stock in trade, I cannot, because once it is done, you cannot change it frequently. C8 Gopalpura 336 at year 287 recognized the CBDT circular of 2004, circular number 4 of 2007, dated June 2007. Conversion of capital asset into stock in trade and stock in trade capital has its own consequences. With the introduction of 28.2, now if I have a stock in trade, I convert it into, when we suppose into capital as the date on which, suppose I'm an individual, I bought 1 crore share in the year 2000, 1 crore of Reliance share in 2008, and in 2018 I converted into my stock in trade into my investment. The date on which I make an investment, it would be deemed to be my profit and loss account, and I have to pay in tax, though I have not sold the shares. This has come into effect 2 years back. So this is a recent change, not a logical change, but law is law, you have to follow it. There are many, suppose I transfer from AOP to my per member, AOP to member, partnership to partner, capital to partner. There are different things. For that, already presentation is available in my blog on the subject. So I'm not going to talk on that. So government has to make it a very safe one. Circular number 6, 2016, dated 29th February 2016. If taxpayer wishes to treat security as stock in trade, AO will not change the same. Listed shares and security held for more than 12 months can be offered as capital. It cannot be challenged by AO. Position taken by taxpayer has to be followed consistently. This law is not applicable to bogus transaction or a sum transaction. What is bogus transaction? You have invested money and you have withdrawn the money. There are certain shares are traded as bogus shares or dummy shares. It will not be considered into that. And further circular under section 225 2012, this is an instruction ITA dated 2016. Gained from transfer of unlisted. This is an instruction. Circular is binding on department. Instruction is binding on not binding on department. A gain from transfer of unlisted shares shall be treated as capital gain in the absence of market of unlisted shares. As I have invested in unlisted share, it is always considered as capital asset. But here it is said that when you invest for the purpose of control and management, it will be considered not as stock in trade. But I tell you, for control and management, it would be more appropriate to consider as investment because we are going to hold it always for a very long time. So this circular also not applicable for bogus and some transactions. Now we are very clear what is considered as stock in trade and what is considered investment. When you consider an investment, the loan taken for the purpose of investment will not be allowable expenses. When you consider as investment, your interest and other expenses would also be allowable as an expense. I give an example. I bought Reliance for 2 crore. I borrow money for 2 crore. If I have invested for the purpose, if I consider as my capital asset, the interest expenses which I incurred would not be allowable expense. But if I consider as a stock in trade, my expenses incurred for 2 crore, the interest by me would be allowable as a business expenditure. So now case study number 2. This case is for the purpose of transfer of a company holds 5,000 equity shares. Shares. Market value in rule A and UAA. Okay. Now let us say that I've got 1 lakh rupees is a share capital. Reserves and surplus 3 crore. So total and liability side would be share plus reserve fund is equal to 4 lakh. Immovable property, my value is 2 lakh. Jewelry, 1 lakh. Other current asset, 1 lakh. Before, so my book value as per in Mr.A company is 40. Fair market value. Fair market value is the market in which if I sold in the market, I would be available to have this price. Say equity share capital, fair market value of immovable property is 4 lakh, but for the purpose of rule double A, it is 5 lakh. Brand value will not be considered under rule double 1 UA. So that will not be considered as nil, but brand, when goodwill I purchase is self-generated, it has a value, and it always generates cash flow in the years. So for the purpose of fair market, it will be added to valuation. Jewelry is per jewelry valuation, other current asset, a fair market value. So for the purpose of fair market value, it will be 110, but rule 1111 UA, it will be 80 rupees. So now case study goes further like this. A transfers 3,000 shares to his son at rupees 50, and he sold 2,000 shares to Mr.X, his old age maternal uncle, who is the non-relative for definition, but he's out of love and affection, he gives the shares to him at a cost of nil. So valuation of shares of A company as on 31st July is sale of 50,000 book value 80 to 2,40,000. So I received 1,50,000 from my son, okay, Mr. B, 1,50,000 book value, 1,20,000 fair market value, 3,30,000. Rule double one UA, 11 UA, 80 rupees. So for my calculation purpose, consideration would be used, and rule 2,40,000 rupees. Book value in fair market would be irrelevant for the purpose of computation of this. Now, for the purpose of gift, here consideration I received nil, book value 80 rupees, 80,000, book value is 40,000, fair market value 2,20,000, rule 11 UA 1,60,000. So consideration would be nil, rule 1 UA 1,60,000. These two values will be used for the purpose. Book value in FA is not a value to me. So now, what would be the impact for what impact of transfer of 3,000 shares to Mr. B for a principal triggers capital gain on transfer of equity shares. 50 CA imputes full value of consideration if transfer at less than 11 UA. So here he is sold at 50. He received consideration 50. But for the purpose of this consideration, value would be taken as 80. Let us go here. So here 2,40,000 would be the valuation, 1,50,000 is the consideration. Let me go to the example here. Okay. On application of 50 CA, 50 CA capital gain is to be decided instead of 80. As 50 CA says there, whenever valuation comes, it would be as per rule AA. This 50 and 50 CA is almost on the similar pipeline. 50C is applicable for purpose of movable property. 50C is applicable for unlisted shares. Mr.A is subject to tax at a consideration of 2,40,000 instead of 1,50,000. Fair market value is of no consequences. No carve out is given 50C when the shares are transferred to relative. 50CA applies to relative as well as non-relative. No taxes in the heads of B under section 50U2A as transaction fit within the carve-out value. As 56.210 will be applicable for gifted property. Here, this will not be considered. So 56 to subsection 10, Mr. A sells sells at a less than consideration to Mr. B, there will be no gift. No 56 to 10 will be added. So no income from other sources under section 52. No cost set up in the hands of Mr. B, even where Mr. A has suffered a decision of 57. So Mr. A has to pay tax at the rate of 80. So 80 into 3,000, 2,40,000 will be consideration. Cost plus will be considered. Provision of 6650C are applicable to unquoted shareholding. It does not apply to listed shares which are quoted regularly in mutual fund, so it doesn't apply. So are you clear? For the purpose of sales consideration, 50CA valuation taken. 56 to 10 gift will not be taxed in the hands of Mr. B. Now the case is reversed. Impact of gift of Mr. B, Mr. X has given a gift of 2,000 shares to his maternal uncle. No trigger of section 47(3), as it is considered a gift, will or without consideration. So 47(3) will not. 50CA competition being a provision cannot override the exemption. Exemption under section 47(3) is available whether capital is transferred to relative or non-relative. So receipt of shares by Mr. X, non-relative, without consideration will trigger to 56 to 10. So 56 to 10, 80 rupees minus 1,60,000 will be added to the income of Mr. Relative, Mr. X, non-relative. Mr. B, his son, it will not be, it will be gift tax free. But in case of non-relative, he has to pay tax on 1,60,000. The amount 46 to 10 will be added to the income of Mr. X. So this is case study number 3. Impact of 56(2) on the issue of fresh capital. Now, shareholding prior to right issue. Mr. B, 50,000, 50%. 50% to Mr. both Mr. A, 50,000, 50%, Mr. B, 50% in A company. After issue of right share, share. What is going to, what is not applicable, let us consider that. A is a family operated business. Mr. A and B are cousin brothers and are having equal shares. Shareholding are not aligned to control and management of the company. Under the family arrangement, it is agreed that 95% of share will be with B and A offers the shares at a face value of 10, while valuation under section 100 UA is ₹100. B does not participate in the issue, as it does not participate in the issue. Post right issue, 95% share of Mr. A and Mr. B would have 5% share. The reason for non-trigger of shares is more important. 56 to 10 is triggered when one person received from any other person a specific property without a consideration or considered less than 11 value. Does language requires an existing property? Is right to use in existing property? No. You go to Sri Gopal Jalan Company, 196 AIR 250, and RD Goel versus Reliance 2003, 1 SAC 81. Does when right issuer says there are no Mr. B does not let go anything. Though on paper you seem to think so, but it is exactly it is not so. Company A makes no transfer in the course of fresh allotment. Neither company A let go anything, neither Mr. B let go anything. So there is no transfer of anything in the case of fresh allotment. Is receipt corollary to transfer? Corollary of a transfer? Receipt of shares is an allotted company, not an owner of company doesn't own the shares. Shares are owned by the members. So that will not be applicable. Circular number 1, 2011 provides that the provision covers the transfer and receipt still not withdrawn. No specific mention that fresh issue is beyond section 56(2)(8). So it will not be considered as an allotment of any right. So 56(2)(8) will not be applicable. 7 will not be. Circular number 10, 2008 provided that the provisions cover the cases of transfer and fresh issue of capital under view is beyond 56(2)(8). Circular says right issue, fresh issue of share 56(2)(7) will not be applicable. Same is circular number 3, 2019, though implemented, withdrawn, but old circular will still be valid. Let us hear, this is a case of family settlement transaction. Family transaction cannot be subjected to 56(2)(10) because there are some pre-existing right of each other. And as a matter of family settlement, somebody would go say, let go something, somebody would get something. In order to settle, some may get some more money and some may get some less. But it will still be considered as no gift under section 56(2)(10) in the case of family settlement. Under bona fide family settlement, sum of money asset is received pursuant to pre-existing right. And it is not consideration in the case of Maruti Pillai versus Mathuri Narsimham, AIR 1966, SC 1836. Family settlement does not result in transfer of property, absence of transfer, thus there is no receipt. In that case, 56(10)(2)(10). In the case of 95, 50-50 converted to 95 will not be considered as transfer. DCIT versus Paras D. Kundecha, 155 880, amount received in the family settlement cannot be taxed under section 56(2)(6) as per ITC, as it is not a realization of existing right. Now we are going into third. Company issued a bonus share, where the bonus share will be considered as a 56(2)(10) transaction. Let us give an example. I've got ESC capital. I'm talking about pre-bonus shares and post-bonus shares. Equity share capital is 10 crore. Reserves and surplus 7 crore. Okay. So market rule as per rule 11 UA will is rupees 80. Suppose now I issued shares of rupees, issued a bonus share 1:1. After bonus, my share capital would be 20 crore. Reserves and surplus 60 crore. Book value as per 40. Would thus I go? So Mr.A is having 1,000 shares. He get 1,000 bonus share. He is to pay nothing. So would it be considered as 56(2)(7)(2)(8)(2)(7)? No. CAT versus investment 1964 year 62 Supreme Court. Bonus is not covered under sector. Raj 180 TTJ 714 Bangalore. Relying on the above Supreme Court ruling, Tribunal has that bonus shares are received for a consideration equal to reduction in fair market value of shares. DCIT versus Mamata Banerjee, not liable for capital gain tax, not liable for 56(2)(10). Even otherwise, once you receive the bonus shares, okay, even if your shares are listed in a stock exchange, suppose let us take an example. If Reliance is today trading at 2,500, as soon as bonus is declared 1:1, so the shares will be traded at 1,050 plus something. So it is, you are getting not only 100 shares, but your value is also reduced. You are only transferring the entry. So bonus share will never be considered as without consideration. It is only a partition of your shares. Let us go into ESOP now. Impact of 56 to 10 on the issue of ESOP. Promoters and public. Let me give you an example. Company list company is a company whose equity shares are listed on a recognized stock exchange. List company has floated ESOP under which shares are granted to employee at a face value of 10, having face market at fair market value of 1,000 shares. Whether issue of shares and ESOP is taxable under the head 56 to 10, not received without consideration. When an employee get a ESOP, he doesn't get a free. He receives money because of existence or a company. He's benefiting the company by working with the company. So it is never considered as 56 to 10 as a gift. It is covered under salary chapter, chargeable to tax under 17 to other purposes. And always 56 to 10 will be applicable if it is not considered any other income from any source. If it is available salary, it will not be available from income from other sources. Income from, there is a judgment in the case of Nalika Dambalal Bodhi versus SAL Narendra, CAT 61 ITR 428, and another case CAT versus DP Sadhu Brothers, Chembur Private Limited 273 ITR 1. Fresh issue of shares to employee are not covered under section 56 to 10. Suppose for the purpose of valuation, let me go again like that. Rupees 990 in this case would be added to 72 as a perquisite per share in the hands of ESOP employee. Now we are going into case study number 4. Transfer of shares under pre-agreed arrangement. Mr. A and Mr. B are non-relative and each hold 50% share in AB company. AB company is engaged in a mining business. Mr. A and B agreed into sale agreement in September 2020 under which Mr. A 50% stake in ABN company from Mr. B. So Mr. A and B are entered in agreement. Mr. A 50% in ABN company on the date from B. So A is buying from B 50% share. 50% share from Mr. B. On the date of entering into agreement, 11 UAA, value at fair market is 100, agreement were made at 120 by paying a premium because he is going to have a control. Share transfer form is executed along with handling of shares in January 21. The delay is attributed to the regulatory approval required to transfer the shares. On the acquisition, the market value, fair market value, or 11 UAA value was 150. So, which date would be considered as transfer? There was a delay from September 2020 to January is because of regulatory provision, because mining division and finance minister's permission is required before transferring the control and management. So would this 30 rupees would be added? The price they have decided at 120, but transfer is at under section 56. Let us go to 56. 56 says that when a asset is transferred, the stamp value will be considered. But if there is an agreement made before that, the date of agreement would be considered. Here in the section 50 CA is silent. Let us go further. Clinically, if you look at it there, so Mr. A would be less than January 120, 150, document is made 110. Would this say will be liable at 40 on the as in the hands of Mr. A? Whether A can advance the following argument. Mr. 50, the language was the purpose. Agreement. Upon end to obtain specific performance and enforceable right in the property. On entering into agreement, Mr.A acquired the right to possess and retain appreciation over and above the agreement value. Appreciation always belongs to Mr.A because therein agreement is because transfer is mobile property agreement has happened. Consideration pass on. Only execution is pending. On the execution, Mr.A acquired the share by working upon his right. On the date of acquisition, Mr.A sacrificing exercise price plus the execution right. So this is like a future and option shares. You buy future option 150. On the date on which you buy it was 120. The same way, this is the case. Now let us go to the case of Mr. Transferor. Normative valuation is 50 on the date of transfer body has the value of consideration. Clinically 50 says triggered. Mr. A.B. can advance the following argument to defend 50CA taxation. Whether the virus of 50CA can be challenged on the basis of KP Varghese ITO 131 ITR 587. If you go into details of the share, there it is said that whether by entering into agreement certain enforceable right were created in favor of buyer, hence the date of transfer is the date of entering into agreement. What KP Varghese says, you can derive from that the date of transfer is the date of entering into agreement. Can reference be made to ruling rendered under section 56C where the tribunal have taken a view that absence of provision, date of agreement was considered as to compute the stamp valuation. So in the stamp valuation 50C specifically says that date of agreement is always can be considered, though the stamp value may be differ when you agree when you actually go to first stamp valuation. But date of agreement would be valid. Here the tribunal says that the date of agreement provision is also not needed. Now let us go to study number 5. This case study is quite in detail. Now these are very, though it seems to be complicated, it is always applicable in many of the cases to come. Let us go into study because you just keep the case study in your hand. Whenever such type of case comes, you just fill up the figure which is applied here. Let me give you an example. B company is a company whose equity shares are listed in Bombay Stock Exchange. Mr. X is acquired 100 shares on 1st April 1995. Here is a table. Event, date of event, number of shares and amount per shares. Acquisition of shares of B company. 1st April 1995. 100 shares, 1,000 per share. Okay. Mr. X was share on 1st April 1995, 100 rupees, 1,000 shares. Okay. Number of shares, value rupees 1,000 per share. Fair market value on 1st April 2001. So cost or market value. My here first A1 for 2001 value or the value at which I purchase, whichever is higher I have to take. Here the value is 1,500. The value would be taken for the purpose of 52AC 1,500. Now I received 1,000 bonus share between 1st April 2007 to 31st March 2017. One bonus share with nil cost. So value would be taken as nil. Fair market value is on 31st January 2000 Grand Parent concept 300. Scenario number 2. There are two types. He sold share at 1,500, 350, and his scenario number 2. He sold it at rupees 200. In both the calculation would be different. So here 350 different plus bonus share different, original share would be different. Okay. So I'm giving further agreement to follow. On transfer of 1,000 share, 1,100 share, 100 original and 1,000 bonus shares of B in a BSE stock exchange, whether X came a 52AC at lower at rupees 10% rate with 112A. 112A for LTCG you can take at 10%, STCG 15%. Let us go further. Transfer of shares of list company can impact cost of zero. Condition to be satisfied to enter 112A of income tax at lower rate at 10% benefit of cost of living under 31st July. There are certain conditions. Total income shall include capital gain on transfer of equity shares. STT is payable at the time of is to be frozen. What no STT will not be applicable in this case. Let me remind you again. Higher of post April 2001 or cost acquired, whichever is higher. After that, it will be indexation would also be available. Here in this case, 1,000 rupees was the price, 1,500 was this, 1,000 or 1,500, whichever is higher. Bonus share, it will be considered as nil. Now this sell price and 31st month January 2018 price, whichever is lower will be considered. Now either of these two, then the column number 1 higher of the A and B, 2 A and B lower of these two. Then 1 A or B, 2 A and B, then cost of it would be higher of 1 or 2. So there would be different valuation for the purpose of bonus share, different purposes for purpose of original shares. 200 rupees shares and 350 shares, all will be different. Let us go into the exact example. Here I have sold the shares at rupees 350. First example, original shares 1,000, 1,500, whichever is higher, 1,500. In the second column, cost nil, whichever is nil. Cost of market value, whichever is higher, nil, because I acquired after 1/4/2001. So the value would be nil. Okay. Lower of these two. Now, original shares, I bought it, I sold it. Fair market is 300. 350 is my sale price. So lower of these two, 300. Higher of these two. So for consideration of original share, I need to take 1,500. In case of bonus shares, I have to take it 300. Clear? Yes, no? When it is sold at 350. Now, what is the competition of gain in case of original shares? I sold at 350 minus 5. My sale price would be 345 less my cost of acquisition, 1,500. In the case of original shares, there would be a loss of 1,150. In the case of bonus shares, I would be gaining 345. 1,000 shares, 112 would also be 112 less 1 lakh deduction would be available. Up to 1 lakh, I don't have to pay tax. Now, when I'm selling at 200, 1,500, first column, no issue, 300, 200, whichever is lower, 300, 200, whichever is lower. Now, in the case of 200 share, 1,500 minus 1,500 less 200, 1,300 will be my capital loss. 200 minus 200, I will not be entitled to loss. Clear? Now, any taxability in the hands of a company buyback shares. Now, my case study number next. Any taxability in the case of hand of buyback shares. Even if buyback of shares takes place at less than 100 UA value, unless arguably 56(2), it will not be applicable. Shares or the buyback shares are required to be extinguished, physically destroying 7 days within 7 days of shares. Shares what back cannot be enjoyed by the company. Own shares cannot be considered as capital or property. Proposition supported by, in the case of Mumbai Tribunal case, Vora Financial Services Private Limited versus ACIT, 171 ITD 646, barabar hai? 56 will not be considered under commercial tax officer versus state bank of India, civil appeal 79. With this, let me come back to this. When I buy back my shares, okay, it would be taxable. It will not be taxable because buyback shares are required to be charged at. So now even listed company, when they buy back shares, they are liable for DDT. That is 20% this thing. And further, suppose company has got 10,000 shares. Yes, you should first 5,000 shares, that rupees 10. Next 5,000 shares, 100. Suppose company has buyback the shares. As the company has buyback the shares, the value it will not be taxable in the hands of person who has buyback the shares. So first, on the first of that, suppose let me give an example. 1,000 shares I buy back at a price of 500. 500 minus 10 rupees, 490 rupees. 490 rupees into 23 point something would be taxable, would be considered as a DDT payable by the 1,000 buyback. Base per 3,000 rupees, 110 to 100 will be deducted on the basis of 500 multiplied by 8,000. Remaining balance, company is to pay DDT and there won't be any tax. This has been made a clarification amendment. With this, I come to my presentation. Thank you very much. Thank you. See you again.